Yes, good evening, friends. See, we'll try to learn today the standard financial instruments, right? I'll try to explain the basics of this, which obviously will be helpful to you to get into the subject at little while. I'll try to put proper basics on that. Yes, try to understand that. See, this standard financial instruments, right? Financial instruments is dealt by three standards. Right. If you observe, generally any accounting standard will have 5 parts. Generally any accounting standard is divided into 5 parts. The first part is, we can say, objective. Why the standard and what the standard deals with will be explained under objective para. Next one is scope paragraph. Okay, scope subheading you can say. Scope talks about what all covered by the standard or what all not covered by the standard. Suppose sometimes it is many things are there covered except few things, then we'll say applicable to all except following. Correct? That's how it depends on the standard. Next topic talks about definitions. Right, definitions. What is definition? Definition is the term, important term, which is used in the standard. What is the meaning of that term is under definition. So what is the meaning of the term? You need to know actually definition very well. The next topic of any standard generally, that is equal to recognition and measurement. Right. Recognition. What do you mean by recognition, my dear? What do you mean by recognition? Recognition means recording. Recognition means recording. Recording in books. Okay. Recognition means recording in books. That is simple words mein passing journal entry in the books of account. Recognition talks about 2 points generally. What is that? What to record. Okay. What to record. Right. Next one is we'll talk when to record. That is timing. What to record means, is it asset or liability or income or expenditure or equity, whatever it is, asset or liability, income or expense, equity, what to record, what to debit, what to credit. That is first part. Next part is when to record. When to record is talking about timing. Timing. If you see accounting standard 9 example, it talks about only timing. Our standard AS9 does not talk about how much to record. Measurement we don't say. We'll say simply that is determined by the agreement between the parties. AS9 I am talking. Okay. So when to record is this one. Measurement will talk about how much to record. Right. How much to record. Yes, this is what measurement. Within measurement also, we will have subtopics. What are the subtopics? We can say initial measurement. Yeah, this because these words you need to know. That's why I'm just explaining. Okay, first one we'll say initial measurement. Initial measurement means what? At the time of recording the transaction. Initial recognition, initial measurement. That is at the time of recording. First time when you record, first time when you bring the asset to my books of account. Say asset account debit, liability account credit, whatever, income account credit, expense account credit. First time when you bring anything into books of account, at what amount you are supposed to record it. Right, very good. And the next one is subsequent recognition. Subsequent recognition, this meaning will change from standard to standard. From our standard point of view, subsequent, I will say, on the balance sheet date, I would like to take it like that. As on the balance sheet date, how do you record? Suppose I have recognized an asset. Say example, I purchased on January 1st. If the asset is held by the company till 31st March, which is my balance sheet date, you have purchased one equity share. Example, okay, I purchased Infosys company share. Okay, I purchased one share. Let us say for 1,000 rupees I purchased one share. Okay, This, when did you purchase, sir? On 1st January I purchased. If the same asset continued, means you are holding the same asset till the balance sheet date. That is till after 31st, on 31st March also it is there in your balance sheet. How should I measure on 31st March? That topic is dealt by subsequent measurement. We will call subsequent measurement means measuring on the balance sheet date. This is fourth topic which is explained. Next, fifth last one. We are done with recognition and measurement. Now we are going to presentation and disclosure. Right. Presentation and disclosure. Okay. What do you mean by presentation, my dear? What do you mean by presentation? Where to present? Where? Placement. Is it under fixed assets? Suppose asset is purchased. That asset should go classification. Where it should be classified? In balance sheet, under current, non-current, fixed assets, investment, current assets, other current assets. Where should I place it? Placement. Okay, if it is a cash transaction, whether it is into operating or financing or investing, where should I do? Or cash equivalents? Presentation talks about that. What about disclosure? Disclosure says what, my dear? Regarding the presented item, if some item is presented, information related to presented item will talk. I hope you understand. If you write a fixed asset, say example, property, plant and equipment, new name. Right. What if you write one number, property, plant and equipment is equal to 1000 crore. But what includes property, plant and equipment? Land and building, plant and machinery. What nature of assets? Correct, na? Intangible. Intangible means what is intangible? Is it some software? Correct, na? Or is it just goodwill? Getting my point? Is it suppose some technology is in my hand? Technology in hand is different nature. Goodwill is different. Correct, na? So that's why you need to know the disclosure, what all it includes, breakup and some additional information. Disclosure as required by the statutes, that is Companies Act. In case of Companies Act, obviously Schedule 3. And what is required as per accounting standard also are going to be disclosed under this disclosure heading. Generally, in one standard, we will have all these 5 subheadings. But with respect to financial instrument, which we are planning to understand, right, it is very big standard. They have divided these 5 topics into 3 standards. 107 alone talks about disclosures. 30 pages document, approximately. 30 pages document talks what is supposed to be disclosed with respect to financial instruments. The other 2 talks about presentation as well, recognition and etc. Right. So, this financial instrument is dealt by, right now, we are saying like AS 30, earlier numbers are AS 30, 31 and 32. Now, as per the latest notification, as per the MCA notification itself, they have removed this and they have replaced it with Ind AS directly. Okay, but even though it is Ind AS, standard numbers means 2 standards are still same as AS 31, 32. AS 31, 32 number changed, matter did not change. AS 30 number changed, matter also changed. Getting my point? Right. AS 30 will become equivalent is what, sir? Ind AS may, anyhow, this AS 30 is no more now. The standard was based on old standard of Ind IAS 39 and odd. Okay, but that is not applicable right now. Ind AS 109. Ind AS 109 is a relevant standard right now for study. And 31 equivalent is Ind AS 32. 32 is disclosure standard, that is Ind AS 107. These are all the standards which are relevant for our study. Right. So let us start learning little bit. You don't bother, I am reading, studying from which standard. I will be mixing all the standards. Just don't concentrate on, we are learning one standard that is called a financial instrument. Concentrate on that. Okay, which standard, what should I refer? In exam also you can refer directly financial instrument standard karke you can refer. If you have a doubt, I suggest as per Ind AS all numbers also you can give. Only presentation, disclosures are coming under this. The other things are actually interlinked. Okay, sometimes you have to look at 32 as well 109. So at your level right now, concentrating on which standard will be difficult to start with. That's why I'm suggesting not to concentrate on that. Okay, what is financial instrument? Let us learn. What is a small definition? Generally students, what they do, they don't concentrate on definition. Directly they'll enter into what? Recognition and measurement. People don't read even scope also correctly. That is wrong. Okay, scope we'll discuss at later point of time. But my suggestion, first definitions you are supposed to concentrate. Otherwise, you will not be, there are so many questions asked in CA final. 2-3 questions were asked recently. Is it financial instrument or not? Question. So if you don't know first what is financial instrument, 4 marks question, very easy question, you will miss it. Right? Let's start with what is a financial instrument? Financial instrument is a contract. First we say it is a contract. Okay, it's a contract. Okay, sir, what will happen? Which gives rise to this contract? Which gives rise to, right? Which gives rise to, okay, it will give rise to what, sir? Which gives rise to a financial asset. A financial asset. I mean financial asset, not fixed asset. Okay, it is a financial asset to one entity. Financial asset to one entity, and it is giving rise to a financial liability, right? A financial liability or equity, financial liability or equity to another entity. We should discuss little bit. Yeah, concentrate. Financial instrument is a contract first. Yeah, so it is a contract means basic understanding also. Contract means minimum 2 parties will be there. Yes, minimum 2 parties will be there. Because of this instrument, what is happening? One company or one party is going to record. Means say there is a contract between A and B. If you say whether this is a financial instrument. Is this contract will lead to financial instrument or not? First you should understand, suppose in A books, this person should record as financial asset. Sir, what is financial asset? Yeah, we'll discuss obviously. And for the other party B, other party should record either equity or liability. I hope you understand. It should create equity to other party or liability to other party. It could be either any of this side of it should be the liability side, assume karo. Either it should go under equity side or it should go under liability. Again, concentrate on my wordings. Wordings are very, very, very important. It may lead to wrong understanding. Equity word is used by me, not equity share capital. Getting my point? Equity is a very broader term, my dear. Equity meaning is what? Equity is equal to owner's fund. Equity is equal to owner's fund. We'll discuss about definition also. Equity is owner's fund. Owner's fund includes equity share capital plus reserves and surplus also. So equity share capital is a subset of this big superset. That is, equity is a superset. Equity share capital is subset. Remember the word, whether I am using equity or equity share capital, you should be clear on that. Otherwise confusion starts. Okay, right. Listen, let's take one small transaction. I gave a loan. A gave a loan to B. What is that sentence? A gave a loan. Yeah, whether this loan is a financial instrument. That is a question. A gave a loan. That means obviously for A, is it a financial asset or not? Anyhow, I did not teach what is financial asset. Assume it is a financial asset. So in his books, he will record 100. It's given by me. That's why it is an asset to me. The other party has received, that party co, it is a liability. So other party will recognize 100. Assume loan is a financial liability to other party. Then loan contract, it is a loan is a contract. Because of this, it's giving rise to one party financial asset, for other party financial liability. It's a financial instrument. Getting my point? Or debentures issued by me. A company issued debentures to B company. Yes, it is a contract between two parties. One company, the holder, for him it is an investment. Assume investment in debenture is a financial asset. Then obviously it's creating a financial asset in one person books. For the issuer, it is a liability, obviously debenture, as you know, it's a liability. Good. Suppose A Limited issued share capital, equity share capital. Okay, ESC I have issued. Equity share capital I have issued. Now look at this transaction. Whoever purchased for the holder of company A issued, you are the holder of equity share capital. What is it for you? It's an investment. Is it investment in equity share capital or not? Yeah, I have Reliance company share. Yeah, it is an investment from my angle. So it is a financial asset to one party. But for the other party issuer, it will become what? It will be forming part of equity. So that is financial instrument. That equity share capital is a financial instrument. I hope you got my point. Right. Okay, sir. Let's get into what is financial asset. Let us read this. What is financial asset? Yeah, very important. You need to understand word by word. Okay, right. You should have actually great patience in understanding this instrument. There is a joke on this instrument. What is a small joke? Some accountant had some sleep problems, it seems. Not able to get proper sleep. So he approached a doctor. Right, after 2-3 visitings, doctor suggested this standard only for him to read. You understand why he has suggested this standard? Because this standard, if you start now, if you open first page, you will not understand what is head, what is tail. So where are we? Don't understand. Then obviously after reading first page, you have to close a book and you have to sleep on the same book. So it's a good sleeping pill. So then it is that sleeping pill you should put lots of effort to understand. It's not that easily somebody can share the knowledge. You are also supposed to think from your angle. Okay, so try to participate. It's a financial asset. What is a financial asset? They gave some 4 points. A, first, what is financial asset? Then first point. What is A, sir? A, it says cash. Cash is a financial asset. Okay, what is it? Cash is a financial asset. But is that cash is a contractor? Cash is a contractor. One way you can say contract only. Correct now. Correct. If you see the note, I owe to you करके लिखेगा. Who is liable to you? RBI is liable to you. You take it that angle. It's obviously liquid financial instrument, my dear. Okay, it's cash. Cash means cash and cash equivalents, my dear, always, obviously. A fixed demand deposit, that is fixed deposit, whenever I want, I can go to bank and withdraw my money. Yeah, equivalent, cash equivalent. Is it not? Cash only, correctly speaking. Balance in bank is cash. Cash, if you see accounting standard 3 definition, cash, cash in hand, cash at bank, all demand deposits will be falling under the definition of cash. Got my point? So cash is big one. Cash is a financial asset. Very good. Second one you have to concentrate. That is B point. An equity instrument. See the word carefully. An equity instrument. Yeah. An equity instrument of another entity. An equity instrument of another entity. Concentration is what? Student has to pay attention here. He did not tell the word equity share capital of another entity. You got my point? Equity instrument is telling. You got my point? What is equity instrument first? You need to have idea. No. What is equity? First, can you define? What is equity? We'll come back to this. I told you 4. Correct na? C is there. D also is there. Right. We'll come back to this place. We are taking little sidetrack. Correct na? Right. Okay. What is equity? Tell me, my dear, what do you mean by equity? Equity owners fund, I told you just now. It is residuary interest. Is it residuary interest? Residuary interest in what? Residuary interest in assets after deducting liabilities. That means, right, minus, I am just putting minus after deducting liabilities. Means, in nutshell, simple words may, the one, what I get, suppose you call me as a owner, before that you should say, what do you get? Assets I will get. Assets you will get. No, I don't get. I will get what is left. Residuary is remaining. Correct? Na? It's remaining. What is left over? That is only I am ready to get. Then you are equity. I hope you understand. Right. What is liability, my dear, first of all? What is liability? Yeah, we need to discuss. You need to have lots of fundamental knowledge before you learn this great standard. It's a present obligation. Today I am liable to you. Today I am liable does not mean today I will pay. I am liable to you, but because of this liability, my future economic benefits will be out. Not present. Correct na? It's a present obligation arising from past events. Why it came to you? I did something in the past. That's why this liability came to me. Obligation, it's a duty, a responsibility, where you don't have a way to skip. You have to perform, you have to clear this off. Not optional to you. Okay, because of the unsettlement of which, what happens, my dear? Unsettlement of which, future economic benefits outflows from the entity, obviously. What do you mean by E? Economic benefits. Economic means what? Money or money's worth. Okay, whether money or money's worth is going to be out from my entity, then I'll say it is a liability. Present obligation. Yes, my dear, one small question. One company we have issued what? Preference share capital. Redeemable preference share capital to another entity. Yeah, I purchased redeemable preference share capital. Can you tell this preference share capital in your hand, is it an equity instrument? Is this preference share capital in your hand an equity instrument? First, you are the holder of preference share capital. Are you going to get residuary interest? No. Redeemable means what? Correct. No. Do you have a contractual right to get the money? Yes, you have a contractual right to get the money after some time. Obviously, future only money will come, not present. Right. It is not equity. Equity shoulder, suppose I have purchased one Reliance company share. Reliance company equity share I purchased. Can I go to Reliance company and ask, take your share, give me my money? Do you have that right? No. Correct. Now, if you don't like, you can sell it outside, but company does not have an obligation to pay. Are you getting my point? What is equity? Company should not have an obligation. You don't have right, obviously. They don't have obligation. I don't have right to ask. Both has to satisfy. You have to check both the ways. In case of equity share capital, holder will not have right to ask. Company will not have obligation to pay. But what about redeemable preference share capital? Is it equity instrument? Is it liability? Liability. It's not equity instrument. I hope you understand. Okay. One small thing I'll tell you. Because they ask such kind of questions also. You have to be very clear. You have to be very clear. What is equity is important. Suppose, my dear, irredeemable. Okay. Irredeemable debenture. Or preference share capital. Right. Tell me now, what is irredeemable preference share capital? Company issued irredeemable preference share capital. What do you say? Is it equity or liability for the issuer? Is it equity or liability? You understand the point to value now? That's where you have to concentrate. Not that easy to answer. Irredeemable debenture or irredeemable preference share capital. Assume it is possible. Sir, India may not possible. That I also know. Just think like that, not to learn for the learning purpose. Yeah. Is it liability or equity? Irredeemable debenture. Right. Do you have an obligation to pay interest? You have an obligation to pay. Suppose irredeemable debenture issued at market value. Not market say comparison, same exactly at market value if you have issued, even though it is debenture, at market value. You must have learnt in SFM. SFM one point. Perpetual cash flows ko, how do you bring it to present value? Y1 cash flows divided by cost of capital. Do you know this formula? I hope you know this formula. Suppose market rate is this. Suppose 1000 rupees is the debenture. 10% is the issue rate, coupon rate. Market rate also 10%. Correct, na? Every year how much do you get cash flows? 100 rupees do you get or not? Hello? Yeah, divided by cost of capital and opportunity cost is market rate is again exactly 10% only. Again the value of it is going to be 1000. You getting my point? So issued at market value, then you need not to record for different rate. If the market rate is different, issue price is different, then you have to do some calculation. You have to do some calculation that I will teach you, right, that you will understand. Assume here we have issued at market rate, entire amount, whatever you have received will go to equity because principal I am not liable to pay. Have you understood? Principal, am I liable to pay? Hello, do you have right to come and ask me principal? No. Do I have an obligation to pay you? Are you getting my point? Come out of your general debenture hai to liability karke. No, don't come, don't think that angle. Debenture also can be an equity instrument. A preferential capital also a equity instrument. Concentration on substance over form. Don't go by nomenclature. Nomenclature is debenture. No, it should be liability. Wrong concept. Okay. Before you decide whether it is a liability or whether it is an equity, look into the terms of the contract. Due to the terms, it becomes an obligation for the company to repay something, then it is a liability to me. Because of the terms, when I don't have, my entity does not have an obligation to pay, it is an equity. I hope you understand. Look at the substance of the contract. Don't go by just nomenclature, that is form of it. I hope you understood. Okay, right. Next point, what I would like to say. So that's what is, why did I stop here? Don't read so plainly. So when he said an equity instrument of another entity can be what? An equity instrument of another entity can be what? It can be an, correct now. That means a debenture also can be an equity instrument to another entity. Got my point? Right. One more small example I would like to give. Listen. See, again, same thing. Irredeemable. Okay. Irredeemable preference share capital, debenture. You put whatever nomenclature. I just don't bother. I would like to look at the terms of the contract. Irredeemable means principal not redeemable. Assume. Now, example. Sir, what about interest? Interest are you supposed to pay? I am supposed to pay. Suppose example, agreement is like this. What is agreement is like that? Interest payment is at the option of the issuer. At the option of the issuer. Means what? If issuer wants to pay, he will pay. Or suppose this interest payment is linked to equity dividend. When I pay to equity people dividend, I will pay you also interest or preference dividend. Whatever you say. At the option of the entity. Now tell me, is it equity instrument or liability? Yeah? Pure equity. Is it not like equity share capital? Equity share capital also, the holder of equity share capital cannot go and ask, get me my dividend. Even same position for me. The holder of irredeemable preference share capital, who does not have an option to, correct, na call for, correct, na demand the interest or preference dividend, it is equity. That's, I hope you understood the word, importance of it. First word is what, my dear? What is financial asset? First one is what? Cash. Next one is what? An equity instrument of another entity. Equity instrument, not equity share capital. Generally what students feel, they will write equity share capital. They'll feel I wrote excellently. That is what we will catch you. I hope you understand. So be concentrate. Just pay full attention on the subject. Yes. Let's go to the C bit. C bit. We have got contractual rights first. It's giving contractual rights. Contractual rights. Contractual right to, right. What is contractual right? So sub bullet points are there. Contractual right to receive cash. Contractual right to receive cash. Contractual right to receive cash or another financial asset. Another financial asset. Yes. From other, correct, na, contractual right to receive cash from other entity or other financial asset from other entity, or another entity, right, another entity. Question, correct, na? Do you receive, means do you have contractual right? Contractual right means as per the contract, I can go and demand cash, pay me cash. Getting my contract is giving me that power, right to ask him. Okay, cash he used, cash means money, not money's worth. Are you understanding my point? Cash, but not money's worth. I suggest you to write money's worth and cut it. Okay, right. It is contractual right to receive cash, money's worth, or another financial asset. Another financial asset means it should again satisfy, it should be one of the four only, no? Are you getting my point? It should be again one of the four. Then only you can say that contract is a financial instrument. I hope you understand. Say example. Right. I paid to somebody prepaid expenses. In my balance sheet, prepaid expenses are there. Tell me, is this prepaid expense financial asset? You need to understand, no. Without that you will apply for everything means wrong. Tell me, prepaid expense, is it financial asset? No. Why no? Prepaid expense, what you will get? Service you will get. Say example, for AC maintenance I paid X money. What do you get? Whoever received money, that person will not pay you cash. He will serve you that what comes is money's worth but not money. You got my point? Next, advance to supplier. Correct. Advance to supplier. Is it a financial asset? No. It's a contractual right to receive goods or services, whatever you say. Correct, na? But it is not asset. No, it is not. Loan given to somebody. Tell me. Loan given to somebody. Yes, tell me. Is it financial asset or not? Yes, no. Yes, why? Contractual right to receive money. Accounts receivable. Yes, no. Yes. See, my dear, now try to understand. Balance sheet may earlier, was there any standard which covers loan given? Was there any standard covering loan given how to account for? No standard. Accounts receivable, was there any standard to consider? No. Where almost gaps are there. All that can be filled. Suppose some point is there. Equity share capital, which standard is applicable right now? No standard. Equity accounting will come here now. Okay. Miscellaneous expenditure you spent. Issue expenses. Which standard is there? No standard. It will come under this standard. Means what I would like to say, in balance sheet, where all gaps are there, almost every gap, you can fill it with Ind AS 109, 107, 32. I hope you understand the importance of the standard, which all, correct now. Loan given, loan taken, tell me. Loan taken. Was there any standard? Was there any standard? No standard. Now 109. Obviously applicable. You understood my point? Yes, like that, so many things are there which will be falling under our standard. So many things like which are all not covered by other standards, almost everything, 95% of it are going to be covered by 109. Let's come back. It's a contractual right to receive cash or another financial asset from another entity. Cash but not money's worth. Understand that bit. Yeah, next sub bullet point again, this is 1 if I say, this is 2. Yeah, it's a contractual right to exchange financial asset. Contractual right to exchange. Exchange what? Either financial asset or financial liability. Either financial asset or financial liability. Okay, either financial asset or financial liability. Right. On such exchange, remember, I'll just first listen, I will write, you also can note down. On this financial asset or financial liability, the exchange it is going to give me potentially favorable. That exchange is going to be potentially favorable to the entity. Means if I give something, if I get something, in such exchange, that is going to benefit me. Obviously, which benefits you only is an asset. But that too, not just probable or something is closing, potentially favorable. There are very high chances to get you be into positive side. Right. The exchange, right, note down, with another, this is all with another entity, which is potentially favorable, to the entity. In this exchange of asset or liability, you are going to get some economic benefits that to potentially favorable to you. Yeah, I hope you have some idea of option. Do you know some option SFMA which you studied? Correct, very good. Do you know call option, my dear? I hope you have that call. What is call option? What is call option, my dear? Call option, calling, correct na? What is call option means what? I have right call to buy, put to sell, put in the market to sell. To remember, generally I'll say like that. Calling somebody to buy, I'll come, I'll buy. Yeah, call option reason. In call option, two parties will be there. Yeah, what are the parties you call? Writer. Do you know? Holder. Very good. Say call option of one company, Reliance company share. Let's take it like that. In this contract, this is a contract or not? Obviously a contract. Right. Let's say there will be some exercise price, I hope. Yeah. Let's say exercise price is equal to 100 rupees. Today we'll enter into this contract agreeing to the terms that I will buy from you at 100 rupees. Okay. Suppose on the date of whatever expiry date, whatever that date, if it is 110 example, will you exercise this option or not? Hello, will you exercise or not? Yes. What are you exchanging? Tell me now. I am giving my cash, financial asset. I am getting another company equity instrument, a financial asset. Like, correct na? Equity. Is equity instrument of another entity is a financial asset or not? Two financial assets are getting exchanged. Correct na? In this exchange, are you getting potentially, is it potentially favorable to you? 10. Got my point? Right. Look at from the other angle. Other angle means writer point of view. Is it financial asset from whose point of view first of all? Holder, writer. Holder. Hello, holder has the option. So holder for holder, is it beneficial to him or not? Holder has to recognize the asset at its fair value. At its fair value, correct na? Which is going to be, say, some financial asset in your balance sheet, 10 rupees is going to give you. Correct? This option is going to give a right to exchange two financial assets. One, my cash I will give, the other person will give equity. In that exchange, I am going to get 10 rupees. This is from holder point of view. Look at from the writer point of view. When you have right to ask him whether writer has an obligation to pay you. That means, can I say, we can define now only, financial liability mein one point will be, it is a contractual obligation. Are you concentrating? Contractual obligation to in exchange of financial asset or financial liability, which is potentially unfavorable to him. Then will it become a liability to him or not? So, in writer's balance sheet, this guy has to record there is a loss of 10 rupees to you. Assume net settlement is taking place. What is going to take place? Net. Net means what? Am I supposed to pay him cash or Reliance share? Net settlement. I hope you should understand this. SFM terminology is required. This standard ke liye basic requirement is SFM also. Because we will be using the words of derivative, option, put, correct na, future, everything, swap, yes, all this will come automatically into discussion. So it is required to have basic knowledge. At least basic knowledge is you can understand accounting. So listen, I hope you understand. Option is a contract between a writer and the holder. Because of this, you are going to exchange two things. Correct na? If you really exchanged, listen carefully how to read the definition, Pado. If you are going to exchange actually, that is not net settlement, actual delivery. If it is actually delivery, then it will come under second bit. Hello? You are going to exchange financial asset or financial liability, which is potentially correct na? Correct na? So suppose net settlement also, then you have got, because of this contract, you have right to receive cash or not? Agree? Under any of them, will it fall under financial asset only? That's all. I hope you understand. D point, right now, D point is not applicable to us. Why? I will tell you. D point may what it says, I'll just read out for you. Okay? Just listen carefully. A contract that will or may be settled in the entity's own equity instrument, it says. What is it saying? You are going to get what you are going to get on settlement. It is an asset to you, first of all. It is a contract. Because of this contract, what are you going to get? Your own equity, share capital. Your own equity. Are you getting my point? In India, can you buy your own company share? Yeah, it automatically leads to buyback. Buyback, can you do just like that? No, there is some procedure prescribed by the Companies Act. Correct na? You may need to do special resolution. Correct na? And etc. etc. So many things are there. That's why this line, D point, I say right now not applicable to the country. I hope you understand. You cannot get your own share capital into your balance sheet asset side. You cannot purchase. With whatever intention, does not matter. If you purchase, that leads to buyback. Buyback without permission, without a procedure, you cannot do so. That's why this point I am saying right now not applicable. So if you read only the first three points, that is financial asset. I hope you understand financial asset. Right. Can I give you a small question to think? Yeah, listen carefully. I have got, say, A entered into a contract with B. A, B, there is a contract. What's the contract? Okay. Guaranteed, it's a forward contract. You take it as a forward. Forward, future, anything you put, no problem for me. Forward, future, option, put all the names. No issues. What is the contract? Forward is what? I will purchase one asset, say some fixed asset, or some bench, table, something like that. Some property, plant, equipment, some asset, any asset. Okay? This table, property, plant and equipment, if you are going to buy, at a specified rate is also given. How much? At the rate of 1,000 rupees. When did you enter? On 1/1 you entered. When do you settle it? Let us say I will settle on 30th 4. Okay, right. Now the question is, are you getting my point? Yeah, question is, on 31st March, whatever the table value, whatever you say, commodity, correct na? Commodity, worth is equal to 1200. Which dates are on 31st March? Balance sheet date has come. Right. Now my question, first, in the practice, if you see the history between A and B transactions or my company transactions, we have taken always delivery of the asset. We have always taken delivery of the asset. We purchased the asset. Means we took the real delivery. Means we paid agreed rate of 1000. We took the chair. We took the asset. My question, is this contract a financial instrument? Yeah, whatever. As of 31st March only you tell, 30th 4 also you tell. Is it financial asset? Same question is asked in examination for 4 marks. To answer this, I solve 10 sums. Do I get kya? Without reading definition properly, can anybody solve this? Not at all possible. Tell me. No net settlement. It is always delivery. Okay. So you say not a financial instrument. Very good. Any other point from anyone? Yeah, what he said is correct. First, before you say it's a financial asset to one party, tell me, first, is it cash? First condition, it's not okay. Next, is it an equity instrument? It's asset, I told you very clearly. Some building, something like that. Example, some property, plant and equipment, something which is tangible, you feel. Right? No. Do you have contractual right to receive cash? No contractual right to receive cash. I will get what? That's all. Right. Is this exchange of financial asset and is it first financial asset? Hello. I have one mobile. Tell me, is it financial asset? How it is a financial asset? If I have mobile, are you liable to, means are you going to get money from somebody? Hello. It is an asset held by me. It is not a right to receive money from someone. If it is accounts receivable, idu asset. Is it a financial asset? Are you following? How? Yes. You have right to receive money from debtor. I know which party also. I have debenture in hand of Reliance company. Tell me, is it financial asset? Yes. How it is? Right to receive. Correct. Now of another entity. I have Reliance share or equity, whatever. Equity share capital of Reliance company I have. Is it financial asset? Yes, I have. Correct now. I have gold, sir. Gold biscuit is there. Is it financial asset? Yes or no? Gold biscuit is not equal to cash or cash equivalent. Okay, because it does not satisfy the definition of cash equivalent even. Correct. Now, highly liquidable, correct, but with negligible loss of value. That is the second condition is there with respect to cash equivalent. It cannot satisfy because fluctuation will be always there. So it is an investment to you gold, but if I have gold, anybody will pay me money, yeah. Not like it's a right to, it's an asset with me, not a right to collect cash. It will not. Suppose gold bond is with me, then gold is different, gold bond is different. Suppose I have a gold bond. Tell me, is it? Hello, understood? Yes, it is. No, that is not. Bond will not be settled in gold. Don't worry. The delivery is going to happen. That is not. Now here in this question, you are going to get a PPE, property, plant and equipment. An asset is going to come. You are not going to get what? Cash or any of the financial asset. A PPE is not a financial asset. That means it is going to be settled by something other than, correct now. Suppose same contract, agreement is like this, settlement in net. I hope you are following me. Right. It's same contract is going to be settled in net. Net means what? I don't get the chair or something. I will get the balance 200 rupees. Now, will it be a financial asset? Yes. How? You have right to receive cash. Correct, na? Yes, that's why it is net settlement means obviously it happens in cash settlement, which I am supposed to say. I say obviously a financial asset. I hope, guys, you understood. Right. So, shall we look at the other definition? Foreign currency is a cash. Obviously, no? Correct. What is financial liability? Yes, please. But he is not getting cash, no, again. Cash is giving, but the exchange is not financial asset or financial liability. So for both of them, it is not financial instrument, first of all. For one party, it is not a financial asset, then automatically instrument definition only you are not satisfied. Getting my point? Yeah, come back. So if you come to financial liability, yes, my dear, what is financial liability? Financial liability, first one only he'll say contractual obligation. It is a contractual obligation. Right. It's a contractual obligation. Contractual obligation for what? One, to deliver cash. To deliver cash or a financial asset. Financial asset of the entity. Correct, no? I can write to the another entity, obviously, of the entity to another entity. Yes, we have an obligation to, correct, no? To give either cash or some financial asset of the entity. Are you getting my point? I have to pay them either cash or financial asset. How do you settle a liability? You have to pay something, no? Correct, na? Right. Sir, I will pay liability by giving my building, sir. Will it come under financial liability? Yeah. Are you giving cash? No. Building, is it financial asset? No. Then this contract is not financial instrument only first. Are you understanding? You should read very carefully. Very carefully. Otherwise, definition only will stop you. I told you, na, sleep properly you will get. Right. Because reading, I hope you understand how just a definition you are now. Correct, na? So you need to learn lot and lot in this. Yeah, there is lot and lot to learn. Everyone, I say. Everyone. That's all. Okay. Nobody is expert here. Everyone of us are learning actually. Right. Come to this point. It's a contractual obligation to deliver cash or a financial asset to another entity. Next, second bit. Again, it is contractual obligation to exchange. It is contractual obligation to exchange. What to exchange? In this exchange of financial asset or financial liability, I already told this sentence. Do you remember? Yeah, this is potentially unfavorable. It is potentially unfavorable to the entity. Yes. In the exchange of financial asset to financial liability or financial assets to financial assets or to financial liabilities, whatever it is, it's going to be unfavorable to me. I hope you understand. This will be writer, correct na? In my earlier example, if I continue, writer point of view, correct na? Writer point of view. Which writer? Call writer. Correct, na? Right. Exercise price is less than market value of the share. When exercise price is less than market value of the share, pakka the holder is going to exercise it. When he exercises, obviously you have an obligation to pay, obligation to lose cash. I hope you understand. Yes. Then it is obviously in this exchange leads to a loss. This is unfavorable, potentially unfavorable to you. Then it is a what is that? Financial liability. Right. Let's try to understand the B bit. Right. Before going to B bit, my dear, try to understand. I have one small point to you. First, we take little sidetrack and we'll come back to the main track. See, let us enter into, right. Let us enter into one agreement. Carefully understand the terms. If you miss one term, means you'll go. That's all. You will not understand later. You will enter into a contract. Say, you will pay me. How much you will pay me? 10 lakh. Rupees 10 lakh you will pay me. What is the agreement? Today you are paying me. At a future date, what did I say? At a future date, I will give you my shares. What do you give? My equity shares only I am going to give it to you. At what rate? Question is always at what rate? Hello, understood? At what rate? If I say at market value, that date. Which day market value? Today, yeah? No, at that date only. At that date only. Are you getting to my point? You understood? Right. Say example. At future date, probability 1. If you have market value of the share is 100, then how many do you get? 10 lakh divided by 100. So we'll come to how much? 10,000. Correct? 10,000. Suppose if it is, suppose that date it is equal to 200. Market value of the company share is equal to 200. How much do you get? 5,000. One small question. In this contract it is okay. Can you write, are you interested to purchase this share, this contract from me? First of all, generally I am asking. Are you interested to purchase this contract from me? I entered with the company. Will you be interested to purchase? No. Why reason? Anyhow, any day, even if I go also, I will also go to market that date, at that rate only, I will also purchase. Na? What is the benefit to me? Hello? Right. Is it a derivative contract or not derivative contract? Is there any derivative? No derivative. In this contract, no derivative. When you say no derivative, first of all tell me, you are going to get variable number. Because price is not fixed today. Hello, understood? Right. I'll change my example. This is probability number 1. Assume what I taught. Let's go to second one. If you see second one, what is that? Same. I will pay you 10 lakh rupees. Okay. I will issue at, I have given today only, issue at 100 rupees each. Correct, na? This is what? This is rate is fixed. Rate is fixed. Hello, understood? Now that is rate is fixed. You are going to give me, issue me shares at 100. Irrespective of the market rate on the date of issue. I hope you understood what I say. You are going to issue me 100 rupees each share irrespective of market rate at that date, on the date of issue. Right. I just think whether game starts or not with this. Hello? Game means market here. Obviously. Game will start or not. How will it start? Suppose market value is gone to 120. People will be interested to purchase your piece of paper. Agree or not? Yes, why? Market rate is 120. I am going to get 10,000 shares. At 120, I will not be able to get 10,000 shares. I will be able to get less shares. Next again you see. Suppose some people, one Mr. X will feel like, today is 120 as per my expectation. By the time they issue the shares, so assume issue the shares is happening after 1 or 2 years. I am expecting the share market of this company rate may go to 220 rupees or 250 rupees. Now what that person will be ready to pay more money for your contract or not? Is this contract is a derivative or not? Hello? Your contract value is automatically going up and down based on the equity share of the company. Hello, understand? Listen, my dear, if you are going to get something in variable, then there will not be any derivative. In this situation, whether market rate is equal to 120 or 250, number of shares are to be issued are 10,000. under any circumstance, irrespective of the rate on the date of issue, okay, irrespective of on the date of issue, you are supposed to, correct, na? Right? It is going to be, fixed number are going to be given to you. Are you understanding my point? Right. If it is a fixed number is outcome, automatically it is a derivative instrument. Are you getting my point? Yeah. Why it is important? Because if you see the next B point, the language is clear, but it takes little time for us to understand. That's why this background will help you to understand the wordings clearly. Right. Listen, what it says. Yeah, what it says. A contract that will, yeah, shall I write? Contract that will or may. See the words. Will or may means guaranteed it will be done. Or may happen. May happen means kind of option. Will or may be settled. May be settled. Settled in entities' own equity instruments. In entities' own equity instruments. In entities' own equity instrument. Listen, how are you settling it? By issuing your own equity instrument. Hello, anything wrong in this? Nothing wrong. I can issue my equity shares. I cannot purchase my own equity shares. Correct? Now, issuing is always welcome. Nothing wrong. What are this? What is and is? Continue. And is bit A mean point 1 down, sub point. What it says? It's a non-derivative. It is non-derivative. It's non-derivative for which an entity is or may be obliged to deliver a variable number. This is what important. A variable number of entities' own equity instruments. Right. A variable number of entities' own equity instruments. Read the sentence once again, please. It's a non-derivative for which, correct na, an entity is or. See, it's a non-derivative. Why non-derivative? You are going to give variable number of shares or a fixed number of shares. Variable means it is obviously varying based on the some rate on the date of issue. Understanding my point? That's why see the wording started word only, they said non-derivative. If you see the next sentence, next sentence what it starts? It starts with a derivative. Same will come. Right. Here you can write simply 2 point you can write. What you write? Copy paste. Same sentence. Non-derivative may derivative it will become. Obviously variable place may fixed it has to become. I hope you understand. A derivative that will or may be settled for a fixed number of equities own equity instruments. I hope you understand. Fixed number, whenever I say irrespective of the market, I will give you fixed number of things, then automatically a game starts. Correct na? Market value will be there for that specific agreement. I hope you understand. Own equity instrument again. Equity instrument, not equity share capital. Equity instrument is broader. We already understood a debenture can be subject to the conditions. It can be an equity instrument. A preference share capital subject to the conditions, that also can be an equity instrument. I hope you understood this. Right. So that is what, my dear. So what did we learn so far? What did you learn so far, my dear? What is a financial asset? What is a financial liability? And what is an equity also you learned. Is it correct? Right. So, yeah, please. Which gives for the financial liability? No, I did not. This question not clear. Yeah, I have an obligation, means I am supposed to pay you. What am I giving you to clear your obligation? That is a liability. Obligation you have means obviously you have liability. You are going to give own equity instruments. That means your FL is going off, your equity is going to be issued. That means liability account debit to equity instrument account. It does not matter, means I'm just telling you, it can be a derivative, it can be non-derivative. Yes, in both the cases it is a financial liability because you are going to settle it with your own instruments. Understand? Yeah, entry will be what? A liability will be debit. It can be credit, equity instrument. Number may vary. Number may vary. If number is varying means non-derivative, number is not varying means derivative. Very simple to understand. Okay. Which entity? Equity instrument of another entity means it is a financial asset to you. That means it is a contractual obligation for you to exchange. You are just cancelling, your liability is going off. You have an asset, your asset of some other entity, you have an equity instrument, you are settling it. Okay, right. That's just knock off now. If that is knocking off me, if it is favorable to you, something will come. Not favorable, 0, sir. That value is 100, I am settling with 100 only. Then there is no favorable, there is no unfavorable, nothing to record as such. Is it clear? Right. Guys, one small question I will just ask you. Investment in equity shares, we have that. Fine. Property, plant and equipment. Inventory, is it a financial asset? Inventory. Just answer. Inventory, is it a financial asset? No, it is not a financial asset. Correct na? Is it cash? Equity instrument of another entity? Before you answer anything, just get back. Right? You remember the definition. Then automatically you will get the answer. Got my point? Inventory I have means what? You have some asset. Correct na? I have inventory means, does it mean that I can ask somebody money? No. I will sell, sir. I will sell his future. Today is an asset. Today, is it receivable? Is money receivable from some other party? It is not. Is already sold means, if it is already sold, it will be in the form of accounts receivable. Why it will be inventory? You understood my point? Be clear on that. Okay? Right. Let us go to what is derivative. Shall we? Yeah, that is also important. Because we use the word derivative, let us learn what is derivative. Yeah, there is one question from Vishakhapatnam. Sir, promissory notes are considered as financial asset, financial liability. Yeah, promissory note means what? It's a loan given by one party, it is a loan taken by another party. So I have an obligation to pay you, obviously cash. In case of promissory note, we don't exchange something. Correct now. So obviously it is a financial asset for the giver, financial liability for the receiver of the loan. Okay, right. Next point. Let's go to derivative. Yeah, what is derivative? Any idea in your derivative? Which one do you say derivative? First, there are 3 conditions to satisfy. First, to say it is a derivative, before you conclude it, there are 3 conditions to satisfy. Yeah, these 3 conditions. 3 conditions. All conditions are supposed to be satisfied. All, not any one. Okay, first one. What is derivative? Any idea, my dear? The value of something, the contract, changes based on the underlying asset. Right, please note down. Value of contract changes in response to, or based on, in response to change in underlying asset. Right, underlying asset. Value of a contract. Okay, the value of this is going to change based on something, underlying asset. Underlying asset, or you can have something, underlying asset or a price or index. It could be any. Correct now. You can purchase some future, index futures you can purchase. Correct now. Right. Based on something means what? Nowhere it is relative. based on something my value is going up and down, then that underlying based, we'll see something. Next word. What next condition? Second condition. It requires little or no investment. Initial investment. Little or no initial investment. It requires little or no initial investment. Okay. Initial investment, that is less than. This investment is less than what? Less than actual investment. Actual investment means what? If I really go and purchase that asset, how much do I need to pay? Are you getting my point? If I want to purchase Reliance Company option, say example, I pay 100 rupees option premium example. Really the value may be 1000 rupees plus. 1000 rupees plus. Is this 100 is less than what actually you purchase? Hello, understood? Yeah, that is what. So the what you are paying money, it may be little investment or no investment. Could be, it can lead to no investment also is okay. It requires a little or no initial investment, that is less than, note down please, less than the investment requires, less than investment required to purchase, less than investment required to purchase underlying asset. If I want to buy underlying asset, I may end up paying huge money. Compared to that, I am paying some investment which is very little. Okay, listen. Next, third. Settled at future date. Settled at future date. Settled at future date. Okay, obviously it is going to be settled at a future date. I hope you understand. Now you should see a derivative. Suppose option. Yeah, I want to buy one company option. Option you know na? Yeah, call option. Call option. What are you? I am a holder, sir. Yeah, call option. What is call option means? First tell me. Right to buy. Right to buy. Is this contract a derivative or not? Right to buy what? A share, equity share, something. A share of RIL. Let's take Reliance Company. Right. Now, is this contract a derivative? Yeah. First condition. What is the first condition? Tell me. Value of this. Obviously. Correct now. Your agreed rate is equal to the exercise price maybe, let us say 1000 rupees is exercise price. Now tomorrow it goes to 1300 rupees. Value of your paper is going to be changed or not? Yes. Based on what? Underlying asset. What is underlying in this case? Share value is underlying. Share is underlying asset. If Reliance Company original share is going up, means automatically my option value also goes up. Got my point? Yes. So that is first one. Next. What is second bit? Second condition kya hai? A little or no investment. Correct na? What option premium will it be? Small or it will be huge? Small. See, generally market if you go, you cannot say I want only one share option, means it will not be available. You have to buy one lot. Lot is equal to how many shares are. That is determined based on the market. That they will decide. It's not in your hands. Okay, but say example, some company may 100 shares will be there, 1000 shares will be, depending on the price of the one also. Say example, okay, got my point. If I say 1000 shares I want to buy, 1000 into today approximately Reliance rate is 1000 only. 1000 plus or minus 100. Okay, 1000 into 1000 means 10 lakh investment you have to pay. If you really want to purchase 1000 lot, really Reliance Company shares I want to buy, 10 lakh you have to take from home. But to purchase the premium, which means only option you want to buy, you may end up paying maximum how much? 50,000, 20,000, 30,000. It's a premium. I hope you understand. Is it little than that? Yes. Got my point. Next, third bit. What is third bit? Is it going to be settled? Yes. Obviously, future date will be settled. Settlement I told, but settlement need not be net settlement or gross or delivery. That does not matter. But one question, is this call option is a instrument, financial instrument? First you should ask, is this call option From the holder point of view, is it a financial instrument? Yes, how? Under which sentence? It is a contractual right to exchange which is favorable. Suppose, example, on 31st March, okay, it's going to be the market value of Reliance share is equal to 900. What do you do as a holder? Don't you keep quiet? Hello? That date, what do you have any value for this? Zero. Zero value, not negative value. Hello, is it a future or option? Option. Option means do you lose other than premium? No. Option, do you know option business first of all? What is option business? Tell me. In one nutshell, I'll tell you. Option business very simple. We'll put toss. Correct, na? If it is head, you will win. You are the holder. I am the writer. Put the toss. Heads, you will win. Tail, I will lose. Have you understood what I told? I'll put this. Head came. Correct, na? King came now. King came means who will win? You, holder. Not king. I will lose. Is it okay to you? Yeah, okay to you. Na? But one sentence. I lost does not mean you won. Remember, I lost does not mean you won. You will not get any effect. Zero you will get. That's all. No option market and together. One sentence you can close. Is it not? Heads, you will win. Tail, I will lose. Correct. That's it. That's what else is there. But for this game is super. Entrance fees is required. That is called premium. Correct, na? When I am taking risk, I will allow you to. Correct, na? Nobody is fool in the financial market. Right. Entrance fees. That what entrance fees again? Correct, na? You'll go to one something. Entrance fees you will pay. Whether you enjoy, do not enjoy the cinema. Like cinema is this is correct, na? Enjoy, do not enjoy. The money will not come back. That's all. Once you paid entrance fees, forget about it. That is what same entrance fees, which is premium, correctly speaking. I hope you got my point. Yeah. So contractual, it is a contractual right to exchange. Yes, I can exchange. In this case, 900 situation may, I don't have right to ask, that person don't have obligation to pay. Whenever he received the premium, he must have already booked the profit. Hello? It's correct. Now, once you receive premium, I need not to pay you. It's over. Forget about it. Correct, na? This person forgot, you forget. No problem. Right? It is 900 means he will not obviously come to exercise the share. I don't have an obligation. When he will not come, how will I have an obligation to pay? So both of them will not recognize anything on the balance sheet date. Are you getting my point? Because it is not unfavorable to the one party or favorable to another party, so it will not come at all. I hope you understand. Right. Both of them keeping quiet means you don't have rights to and obligations to another party. That's where the point. So, right, one more thing. Have you heard of future? Future. In case of future, are you supposed to pay margin money? Have you heard of this also? Right. Margin money, you will pay huge money, you have to pay 1 lakh rupees you have to pay. Minimum right now, approximately one contract, around 1 lakh will be investment. How much will be investment? 1 lakh will be investment. 1 lakh is not that small. But 1 lakh is not expense to you. Hello, 1 lakh is expense. What is it? 1 lakh? Deposit. It is given as a security, collateral security. In case suddenly if value comes down, if you run away means whom should I catch? Correct, na? It is a kind of deposit. It is not an expense. It's a premium is expense. It's gone is gone. This deposit is just collateral security. Correct, na? To clearing house means you don't know. We are entering into future. With whom we are entering, nobody knows. Correct, na? So then what clearing house does? If you have one, they will remove from the other party and they'll put into your account. You lost means remove from the margin money and they'll put into another account. I hope you understand. It goes on like that. I hope you understand, right? So you cannot say future is not derivative because your investment is doing. No, whatever I paid is not a loss or investment. Correct, na? It is a security given to the other party. So in any case of loss, you can use this money first of all. That's why. So no issues to it. So even though this 1 lakh rupees of margin money is there, still we would like to say, what is that? Future is a derivative contract. Okay. Do you know swap? Right. Which swap? Currency swap, interest rate swap, anything you can put beside this. Swap is a instrument. Beside this, whatever you put, that is fine. Oh, swapping means what? My obligation is yours, your obligation is mine. Exchange here. Exchanging one person right and obligations to another person. That's all. Correct now. Because of this, do you have an obligation to pay and do you have right to receive or not? Correct now. So that means you are exchanging the liability. Suppose interest rate swap. Are you exchanging your liability with my liability? That may lead to a favorable or unfavorable. Do you know swap? I expect that from you. Correct now. One person has got fixed responsibility, another person has got variable responsibility. Correct now. Today may be same, but tomorrow it will change. If the rate is changing, automatically it leads to one person profit, another person loss. Correct now. Is it that is a contractual right to receive cash because it is going to happen net? Or you can say other than that, it's going to be a settlement of two financial liabilities, obligations. Correct now, which is favorable to me. I am going to the winner. That means it is a asset to me. I am the loser, then it is a liability to me. Is that clear to you? Right. So end of the day, you need to learn this derivative definition because again you have to see. All derivatives are FVTPL karke I will tell. Sir, what is FVTPL? I'll teach, but before that, first what is derivative also you should understand. Got my point? Because classification, before we will go in the future, fixed financial asset is going to be classified into 3. Got my point? Right. Next, my dear, if any, suppose, one small question. Again, think you have to use another 30 minutes. Is it okay? Right. Right. Now listen. My company is issuing. What is my company issuing, sir? My company is issuing convertible debenture. My company is issuing convertible debenture. Conversion. Convertible debenture. Convertible means convertible into equity share, obviously. At whose option? At holder's option. At holder's option. My dear. It is going to be done at holder's option. Is it clear? Right. Holder option means what? Today I am issuing. Sir, which date are you issuing? Let us say on 1/4/2014 I am issuing. Okay. Conversion date. Which is the conversion date? Yeah, obviously future date. Let us say 31st March 2015, 16, 17. Let's say 3 years time. That date it is going to be converted. But will it be converted automatically? Yeah. No, at the option. That day we'll ask. What will ask? To the holder, debenture holder. Would you like to take equity shares instead of cash? If he says yes, we'll give equity shares to him. It's fully in the hands of the option holder. Correct? Right. When you have issued convertible debenture, won't you mention at what rate it is going to be converted in the prospectus of your convertible debenture? Obviously, you have to mention. Say example, converted at the rate of 100 each. Okay, at what rate you are going to convert? 100 rupees ko one equity share I am going to issue to you. Right. Now, is it a fixed rate or is it variable rate? That means derivative started? Correct now. Suppose that day it is going to be 150 rupees market rate. Right. Now, debenture value goes up or down? Have you understood the question? Shall I repeat? I repeat. A debenture is going to be converted into one share at 100. Are you getting my point? 100 rupees, one share is going to be issued. On the date of conversion, that is this date, one equity share capital of the company is equal to 150. Expected is 150. People would like to purchase your debenture more or not? Why? Obviously, you will automate. If I have the debenture in my hand, I will get at the rate of 100. I don't want also immediately I can sell it in the market. Immediately if you sell it in the market, obviously you will get 50 rupees right away. Straight away. Immediately you will get a profit or not. That's good, no? Right. Now look at the point. Fine. Tell me, is this convertible debenture? Today cash came or not? I issued, means cash must have come, na? Okay, cash account debit. In this, no doubt, na? Say some 100 lakh rupees. To what? What should I do with this convertible debenture? Can I put it under equity or liability? Both. If you say both means proportion, you have to allocate also. We'll see that. I'll come to that point. But first you think, is it equity? Pure equity? Equity means something which I am not obligated to pay. Okay, but something is there still. Okay, right. I receive something, I will not pay you. That is equity. Liability, simple words. I receive something, I have to pay you back. That is liability. Agree or not? Listen, one more word before we come to the main point. See, if somebody has bought this convertible debenture, one more point. See, now just link it. You have to link. First you understand overall background, then only it becomes easy. Plain debenture. Plain debenture means what? No conversion option. Plain debenture. If it's plain debenture means no conversion option. Say, this convertible debenture is equal to, let's say, plain debenture is equal to 10% rate. What rate is applicable in the market? Market rate. 10% mein I can issue any debenture. Plain debenture can be issued at the rate of 10% coupon rate. Question to you. Whether this convertible debenture company will offer, is it 10% or lower than 10% or more than 10%? Is that question clear? I repeat. Your company only can issue a debenture without conversion option at the rate of 10% coupon rate. Suppose your company only issues a convertible debenture. Got my point? A convertible debenture, if your company issues, will you issue at the rate of 10%, lower than the 10%, or higher than the 10%? Suppose I am issuing, will you buy at 8% if I issue, will you buy or not? Question. Why you will buy? Is it not a loss to you? But it is a loss. My expectation is that your share will go up. Correct, na? At that time, last minute mein, don't you get capital gain? I am ready to lose this 2% of interest to get a capital gain at a future date. That is after 3 years. You understood my point? So, in this situation, correct na? We will be offering obviously lower than, not higher than. You are the company, correct? We say we are offering you at 8%. But market rate is what rate, amma? 10%. But offer rate, my coupon rate of the convertible debenture is equal to 8%. From the company point of view, you are looking now. From the company point of view, you are looking now. This 2%, is it benefit to you or not? Hello? That which I am not obligated to pay you only? Hello? Right. Leave that. One more point. The holder has an option in his hand or not first? Holder of debenture has an option also in his hand? What option does he have? Is it not a call option in his hand? Correct, na? Right to purchase. If he is willing to purchase after 3 years, he will buy. If he is not willing to purchase, correct, na? Because just to get that option to buy, he lost 2% here. That 2% is nothing but income to me. That is nothing but premium to me. Have you understood? So premium once comes in will not go out. That means it is a profit. Profit is nothing but reserves and surplus. Reserves and surplus is nothing but equity. Are you catching the point? It is. That means out of 100 lakh my money is coming to me, there is some portion which is in the nature of equity. The remaining portion is in the nature of liability. That's why you cannot classify convertible debenture fully into liability, fully into equity. You are supposed to bifurcate it into two. To some extent, it will be forming part of my liability. To some extent, it will be forming part of equity. Sir, that is all correct. But how do you bifurcate? That is what question. Right. Let us solve that simple question. Do you have calculator with you? Yeah, I need little help from you. Yeah, guys, listen. What do you want first? Tell me. Question, what do you need? Tell me. I want to know how much is correct. Na? Can I say liability is how much? To equity. Equity means reserves and surplus. Profit you can say. Equity includes equity share capital plus reserves and surplus. I told you, na? Yes. How much is this? How much is this is a question mark. Out of 100 lakh. Today receipt of 100 lakh guarantee already came. Cash account debit. No question. Liability portion is how much? Equity portion is how much? That is only the question. You getting my point? Yes. Come back. See, listen. How do you get liability portion? You can do two ways. Two ways. If you know real fair value of equity, option premium, if I know exactly, 100 minus option premium, if you deduct, remaining is liability. Are you catching? I repeat. What did I say? 100 lakh you received minus 100 lakh includes both liability value and equity value. If I know equity value very clearly, sir, then 100 minus equity is equal to liability, balancing figure. Sir, I don't know this, sir, because market may 3 years options will not be available. 3 months options will be there. 3 years options will not be there. Okay, sir, I don't want to do that way. Then you find out what is the fair market value of liability. You find out. When premium is how much you cannot determine, no problem. If you find out what is the value of pure liability without conversion. Pure liability without conversion, if you calculate, then 100 lakh minus value of liability will be value of equity. Are you getting my point? Yes, listen. Can I write like this? Fair market value of equity. Fair market value of equity is equal to, what should I say? Total received. Correct na? Total received minus fair market value of liability. Can I say like this? Yes. So, total received, I obviously know that is 100 lakh rupees. Okay. But I just need to determine this, then automatically this will be balancing figure. I hope you got my point. Sir, how do I determine? Yeah, you can find out fair market value using present value considerations. Correct? Look at, observe, right? Fair market value of liability. I would like to do calculation of Fmv of liability. Okay. Yeah, listen. Year 1, 2, 3. Cash flows. Because of the contract. First year, how much am I supposed to pay? How many lakhs interest? Am I supposed to pay interest or not? During these 3 years, you have to pay interest. Now, I am telling fair market value of pure debenture. The pure liability. Pure. Pure means what? Plain debenture. Does not have option. Correct? If it does not have option, are you supposed to repay it or not? Assumption. Now you are finding only fair. Assume you have issued plain debenture without conversion option. What would be the thing? Right. Now, as per the existing contract, are you supposed to pay 8 lakh rupees per annum interest? Hello? 3 years. That means first year you will pay 8 lakh. Second year 100 into 8%. Agreed term. Cash outflow. Outflow to me is 8. Second year interest 8. Third year 108 along with principal. Correct. Yes. Now, are we supposed to discount? Yes. Present value factor, PVF, at the rate of what rate? At the rate of 10%. Market value you want to find out, market rate apply karo. Then what will be there? 0.909. Getting my point? Yeah, 0.826, 0.751. Can you use calculator? Present value cash flows. Bolo yaar. 7 point. You tell line by line. 7.27. Next. 6.61. Okay, next one. 81.11. Very good. Now, total 90. Bolo. 95.03. Is it? I don't think so. 95 point? Okay, make it 95. Leave it, that small thing. 95 rupees, 95 lakh. Okay, this is 95 lakh. So now look at, what is this 95, my dear? I am coming back. Total received is equal to 100. Fair, only pure debenture value as to 95 rupees. Then obviously amount of equity means nothing but premium received is nothing but 5. Hello, understood? That's why at Y0, I hope you understand, at Y0, that is when you are receiving, that is on 1/4/2014, you should recognize a journal entry. What is the journal entry, my dear? Cash account debit, that is equal to 100 lakh. 2. Liability to pay is 95. 2. Equity, yes, equity accounting. Where you put, under which reserve you put nomenclature, just don't bother. Substance, remember. Nomenclature, you put whatever the account you want. I can say directly transfer to P&L. Okay, 5. Getting my point? So, 5. But one small point. Sir, it's all very good. 95. But end of the last minute, if they don't want to do, they don't want equity share, are you supposed to pay 100 or 95? 100. Correct, na? The difference of 5 is what? Is nothing but the 2% ka effect. Are you getting my point? What will happen? This 95 is going to be unwinded. What do you call? Unwinded over a period of the one. Yes, what do you unwinding? I'll tell you. Listen, opening balance, simple calculation I will perform. Opening balance, interest. Interest at what rate you should recognize? At 10%. Plain debenture you have recognized, na? Plain rate only you should take it. 95 is plain, not including. Right, next, opening balance interest. Payment will be minus. You will pay something. Then obviously closing balance. Yeah, what is my opening balance? This is year. 1, 2, 3. Year, opening balance how much, my dear? 95. At the rate of interest 10% means obviously 9.5. Yeah, total payment will be how much? Cash outflow is 8 only to you. Getting my point? Yeah, tell me closing balance would be how much? Yeah, calculator. What is it? 1.5 will be increased in Nomma. See, 96.5. Is it clear? So 96.5 will be my opening balance of liability. On this again 10%. 10% comes to how much? 9.65. Payment would be 8. Correct? How much? 98.15. Okay, something. Now it will come to 98.5. Correct, na? This is going to be 108. Hello, I am just putting as a balancing figure. I know this if you apply, you may get slight difference. Yeah, just difference you find out, my dear. 98.5 minus 108. How much? 8 plus 9.5. Correct, Is it not? Obviously 0 will be, I'm just taking as a balancing figure. That's okay. That is because of you have rounded off some numbers, na? That's why slight difference will be there. That you can ignore it. It's all fine. How do you record journal entries at Y1? Can we record journal entries at Y1? Then only clarity will be better. Right. Tell me, what is the journal entry you record at Y1? 2 entries I am recording. Y1, Y2, Y3. Let me record journal entries in this fashion. First, I say interest expense account debit. Interest expense account debit. How much? Interest is really speaking 9.5 to me. Okay, 9.5. To liability. I will first add it to liability. 9.5. Done. Next what? Liability account debit. Am I paying 8 rupees or not? Yes. So, liability account debit to cash. How much? 8. 8. Got my point? Now, at the end of the day, balance of the loan is what happened? 95 opening balance. Liability credited means added. 9.5 added. Minus 8 deducted. Automatically closing balance comes to 96.5 or not? So I think same numbers I can just bring it down. 9.5, correct, 9.65, 9.65. Am I right? 8, 8. Got my point? Yeah. Y3. Y3 mein what is it, Isma? Again 9.5, 9.5. I hope you understand. Yeah. Let's say 8, 8 only you bring first. First you pay 8, 8 only. Why 8, 8 only? Because he has an option, no? Hello, understand? If you pay first 8, interest portion I have paid. Have you noted? Right. See, now what is the balance of third year, my dear? Third year, balance sheet mein, liability is equal to how much? Huh? 100. Hello? Third year, which is this? Third year, that is 31st March 2017 I am talking. 31st March 2017, my balance is going to be 100. Now, it can happen two ways. It can happen two ways. What is the two ways? One is not exercised. Correct na? Exercised means cash paid. How much are you supposed to pay him? 100 obviously. That's my obligation. 100 only have to pay. Then what is the journal entry? Simple. Liability account debit to cash. 100. 100. I hope you understand. Right. Suppose you issued equity. Exercised option. Issued equity. Correct na? That is favorable number to him. That's why people have selected. Exercise equity. What do you record? Liability is clear. 2. Equity share capital. 2. Security premium if any. I hope you understand. 100, say 10 rupees, 90 rupees if any. Because I don't know what is your face value of security. Because I am issuing at 100, assumption 10 rupees each. Then equity share capital 10, security premium 90. Is this clear to you? Accounting is you feel. What do you feel? Accounting is okay, not okay? This is good, correct? No, logically that's perfect. But you have to use brain. Earlier, Indian accounting is very easy. Correct, na? Money come, 100 record. 8 paid, 8 only expenditure. Correct, na? What you do last day? Last day, any of this entry will be passed. Kam khatam. Now you have to apply. You have to apply brain. It's not that straight. It requires some professional. It means you have to application of brain is more important. Shall we complicate this little more? Shall we complicate? Yeah. One point should come to your mind, my dear, actually. How much are you charging to P&L? This will go to P&L, huh? Yes. Correct, huh? Yes. But income tax department will agree to what? Income tax department will allowed expenditure is 8, 9.5, 8. But in books of account, how much you charged? 9.5. But income tax books may 8 rupees is charged. That means what? Deferred tax will arise immediately. Understood? Huh? But what is this deferred tax? Actually, if you straight away observe, 9.5 minus 8. See, these two numbers difference is obviously is equal to 5 rupees. Correct? Nah? That 5 rupees only is going to 95 becoming 100 means 5 only going up or not? Hello? Correct. So I am just trying to explain at next level. What did I record just now entry at Y0? Y0. Which entry I have recorded, my dear? Y0 on 1/4/2014 cash account debit 100 lakh. To liability 95, to equity 5. Correct? Is this income? Do you pay tax on this income? As per Income Tax Act. Do you pay 5 rupees tax on 5 rupees? Where do you pay, pa? Which section, appa, nodi? Illa, you don't pay. That means at Y0, it is income to me. Correct, na? But it is I'm not paying tax on it. Hello? When it is income, don't you have an obligation to pay? That means it is deferred tax liability to you. Understand? Suppose on 5 rupees, if that 30% is tax rate, hello? Am I supposed to recognize deferred tax or not? Immediately you should recognize one more journal entry on that date. Same date I am talking. Same date. Kya likhna bol? P&L means equity only, no? Anyhow. Hello, understood? That means equity account debit. Equity is nothing but P&L. I told you P&L reserve, all reserves will be forming part of equity. Debit 1.5. 2. DTL, deferred tax liability 1.5. This is going to be reversed over a period of 3 years or not? Correct, na? On 31st March 2015, assume 31st March 2015. What entry do you record, my dear? DTL, account debit to equity, again P&L only. What else? Deferred tax income करके लिखेंगे. Correct, na? How much will be there? Hello? Is it not? 1 second. Is it not? Difference is how much? 1.5. 1.5 into 30%. How much is getting reversed in first year? Out of 5 rupees, 1.5 is getting reversed in first year. Another 1.5 is getting reversed last year. Hello, there only how much? 3. There is 1.65 something is how much? Almost it will reach. Correct? Now that is what is that? Exactly it won't come. Reason is what? Discounting factor you have taken some decimal points na isliye. Yes. Let me finish first. Okay. Right. Listen my dear. So in this case DTL first year what do you record? 8 rupees minus 9.5, that is the difference. This is the income recognized as per Income Tax Act. This is income recognized in books of account into, is it getting reversed or not? 30%. Whatever comes you will put here. If you put all these 3 years, first year, second year, third year, if you put, automatically 1.5 will be reversed in total in all the 3 years. I hope you understand. Right. Can you call that guy? Right. Yeah. So DTL account debit to equity. DTL account debit to equity. That is how you are going to record. This is how you can complicate also. That's why first I taught you without deferred tax. If I explain first only deferred tax means, yes, then you may not be able to catch. So that's why plain understanding. First we have given you. Afterwards, if you include deferred tax, now you don't feel that much tough. Like this, my dear. Like this. This is just starting. What I have explained you, we are still where? Initial recognition. Initial recognition. Correct, na? Just initial recognition means at the initial recognition, what is fair value? Because if you learn at a later point of time, a financial asset, a financial liability, initially should be recognized at fair market value, it says. Liability is 95 actually. My obligation to pay is actually 95. Correct now? Considering the current market rate of 10%. A market value, how do you get? Present value of future obligation at a current market rate is obviously present fair market value. That's I have recorded the liability at 95, which is the fair market value. That is the present value of my future outflows. It's true. This standard is not that small standard. We just entered at this rate. Means just a small explanation. My point, what I would like to say, just to say, all this explanation I have incorporated in my book actually. That which you know, this accounting standards made easy. Accounting standard made easy for CA final, obviously available in the market in Amazon. This is second edition is right now available, which includes each and every whatever the bit I have explained. How I am explaining to you, it is exactly in the same fashion, in simple language. 100% it helps you to understand the real concept of financial instrument, and not only financial instrument, all other standards are explained in the same fashion. Surely it will help you. I hope you understand this subject. I tried to explain you the basic of this subject, right? Thank you. The reading, right? Reading important. It is actually matters. Close, no?